All right, I wanted to open up this discussion with a few slides from the PowerPoint deck. We're not going to go over all of them. If you want to look at all of them, they're there for your reading enjoyment. This is Chapter 10, Ethical Decision Making, Corporate Governance, Accounting, and Finance, and I want to open the statement. This, like everything else we have discussed in this semester, is based upon faith that people will do the right thing, not the religious kind of faith, but the faith that people will do the right thing. You are making a decision every day whether you trust a vendor, whether you trust a company, whether you trust your colleagues, and it's a big decision. In any event, let's proceed. We talked earlier in this semester about Enron. These authors characterized the Enron disaster as wreaking havoc on the accounting industry more than anything else. Arthur Andersen went out of business. Enron obviously went bankrupt. Blah blah. It's a big deal, and all of this happened because people had faith in the organization. Uh, this is a issue of in our capitalist economy, we have watchdogs, we have trusted advisors, attorneys, auditors, accountants, financial analysts, and these authors talk about the professions as gatekeepers, and their role is to ensure that you're being provided with the most accurate reflection of, in this particular case, a company's operations. Well, obviously, we saw in the Enron story that there were conflicts of interest. Arthur Andersen wanted to continue to have fees, and they wanted to continue to do consulting for the company, and so they signed off on a number of questionable judgments. The the gatekeepers, the Arthur Andersens of the world, as well as the corporate management, have fiduciary responsibilities. They have a professional duty of care to provide you with the most accurate information of their company. But if you read any number of news articles, in many cases this just does not happen. And this is a particular thing, a description of a conflicts of interest, and I think you know what a conflict of interest is. A conflict of interest is essentially your activities may be contrary to the general public good, and most often they're also contrary to your own public good too. But the issue of conflicts of interest is, and the story that I would divine for you is the risk of getting caught going to exceed the benefit, or is the benefit going to exceed the risk of getting caught? And obviously, because of the number of accounting failures we've had over the course of this century and last, most people feel pretty confident that they're not going to get caught, and so they do questionable things. Uh, the critics, and I agree with this, that the government rules will not rid ourselves of conflicts of interest. In fact, if you will note, many of the situations where companies have lost large sums of money, no one has been held accountable, and furthermore, very few have gone to jail. Uh, because of the 2002 rash of accounting irregularities, the Congress lurched into action with the Sarbanes-Oxley Act, and I'll leave it to you to study this in accounting, but it was in order to try to increase some accountability on the part of corporations, for-profit public corporations, to do better, to be more forthcoming. This obviously has an effect on corporate governance, and the brief definition of corporate governance are the rules and regulations, the formal and the informal processes that companies use to do whatever it is that their mandate is. So if you're if you're Walmart again, what are the things that make Walmart Walmart? And that is the corporate governance. It's the rules, both informal and formal. It's the regulations that they operate under. Well, so far as I can tell, um, since this act was completed in 2002, is it has increased the cost of regulating financial information from companies, but it really hasn't solved the problem of accounting irregularities because we still have them. And I would ask you to look up J.P. Morgan Chase and their bond fiasco of some 12 months ago as an example, is but one example of this. So we get to the question of internal controls and how effective are internal control. And internal control is exactly that. It is a process by which one can rely on that will provide accurate financial statements. Well, again, in the case of the JP Morgan issue, there must have not been very good internal controls because one man in London has created a $4 to $6 billion loss for the bank. So I will leave you with these thoughts. There is a duty of care, and this is kind of like with our marketing issue. How do people see you? How do you see people? And there is a duty of care, and these are things that are supposed to happen but often do not. And the duty of care is your ability to do the right things at the right time in spite of pressure to do otherwise. There is a duty of good faith, and that is the things that you do, the things that you report are to your best of knowledge, consistent with the organization's mission and directions, and really the tenets of basic honesty. And there's a duty of loyalty, and that loyalty is that there is loyalty to the organization, but there is also, in my view, the duty of loyalty to its stakeholders and citizens, that people are depending upon these organizations to function properly. People depend upon these organizations to fund their pension plans. People depend upon these organizations for employment. And when individuals or groups of individuals do risky things that bring into question the financial stability of the company, we are not exercising our duties. Of course, this group of authors say that beyond the law there is ethics, and again, I would question whether anybody is actually reading these types of informations, because while there may be ethics and there may be laws to enforce the ethics, people are still doing questionable things, and companies are still doing questionable things. And I suspect as long as humans exist on this planet, they will continue to do questionable things, because the issue of the risk versus the benefit, people eye the benefits, and mostly these are money type of benefits. So we have, again, this issue of conflict of interest, and I would just note that you should go back to the main deck or whatever to talk about the conflicts of interest, but there are many types of conflicts of interest, and these are just but a few. And if you have a conflict of interest, you're probably going to cause yourself financial harm in the long run. Even if you don't have conflicts of interest, you may be causing yourself financial harm in the long run if you're not doing the right things for your company. I do want to bring up the point of insider trading. Insider trading is using knowledge that you may have to benefit yourself. Ken Lay with Enron certainly had insider knowledge and was benefiting himself. There are many folks throughout the last 20, 30, 40 years that are that have benefited from insider trading. Some have failed, some have succeeded, but it's a blight. So anyway, where are we? Where we always are. What are the things that you're going to live by if you go an employee, become an employee within a company? What are the things that you're going to do to promote ethical condition? If you're going to start a company, what are those things that you're going to do to provide an ethical condition? What is ethics? In the end, it is do unto others what you want to have done to you. And as we have said earlier, stick to the facts, be honest, and try to do no harm.